Today, my guest is Jeff Lerman. He is the real estate investor's lawyer. Today, we're going to talk a little bit about joint ventures. But before we do, I want to give you a couple of quick reminders. If you like the show, CREPN Radio, we'd love to hear from you. You can let us know by you can leave a comment, you can share the show with somebody you know, or you can subscribe. Also want to remind you, too, that we have a YouTube channel, Commercial Real Estate Pro Network, and invite you to go check out that as well so you can see the guest and the show. So with that, I'd like to welcome my guest today, Jeff Lerman. Jeff, welcome to CREPN Radio.
Thank you for having me, Darren.
Well, I'm looking forward to our talk today. But before we get going, if you don't mind sharing a little bit about your background with myself and the listeners.
Sure. I'm a bit of an unusual lawyer. I am, as you said, the real estate investor's lawyer, and I'm also a real estate investor. Have been for a long time. We have invested in almost every asset class out there, but our preferred asset class is multifamily. And the topic that we're going to be discussing today is a topic that is near and dear to my heart. Most of the deals that we have done over the last several decades have been using the very strategy that we're going to be talking about, which is joint ventures. And in my practice as the real estate investor's lawyer, our office helps investors around the country with their transactions and California investors with their litigation as well. We only do litigation in California, but we can work with investors in every other state as well. And insofar as transactions, specifically, virtually everything in the cycle of ownership of real estate, from entity formation, asset protection, syndication, joint venture, purchase and sale agreements, loan docs, construction agreements, easement agreements. Again, virtually everything in the cycle of ownership, and that's the big picture.
Got it. Well, I think maybe a good place to start with this is, what is a joint venture?
So a joint venture is the coming together of two or more parties for a common business purpose. The more relevant and specific definition of a joint venture, as opposed to a syndication, is a joint venture is the coming together of two or more people who are, everybody who is actually involved in the joint venture is actively engaged in the joint venture business, and no one of the parties is relying upon another of the parties to make a profit for them. Because if they were, that would be the definition of a passive investor. And the relevance of all that is the main reason that a joint venture has been our preferred type of structure for doing deals with other people's money is a joint venture, if it's formed correctly and it is a true joint venture, is not a security under the securities laws. And that's significant for everybody who's listening who is thinking about doing deals with other people's money. And no matter where you are in this business, if you're just starting out or if you've been doing it for as long as we have, and whether you have one property or 1,000 properties, this strategy is something that is useful and is used by investors at every level.
Yeah, interesting. So the active participation element there, because I think the one of the words you hear so much about in today's environment is the syndication, and the kind of the passive investment. So the key there, if I understood right, though, is active. So can you describe a little bit about how active somebody has to be? Can you define the roles, or?
Sure. That's always the next question, which is logical. And it's a little bit frustrating to people who are trying to make sure they're complying with this, because there is no specific black letter law definition of what it constitutes active as opposed to passive. Actually, the definition of an active investor is investor who's not passive, which is
All
doesn't
right.
really help. So the more critical question is again starting with the definition of a passive investor, which is the seminal case of SEC versus Howey, which anybody who's going to be doing syndication needs to be familiar with that particular case, SEC versus Howey, which basically defines passive investor, as I indicated, somebody who is relying on somebody else. They're basically just giving you money, relying upon them to make a profit. But let me try to give you a couple of examples to try to help. I have one of my deals that I was involved with was a residential subdivision development deal. And there were four partners involved in that joint venture. There was the individual who found the deal and got the loan. There was the individual who was the developer. There was the individual who was a broker who was involved in the design of the homes and also in the strategic marketing of the finished product and the sale of the finished product. And then there was myself. I was the person who brought the money to the deal. So each of us were truly and documented as actively engaged in the deal. And when I say documented, what we did is every week we got on a conference call to discuss the things that typically come up in any kind of a deal, but especially in a development deal, there are going to be more things to be discussed. And we had one person who was the designated secretary for the call, and his job was to take minutes, take notes, and share those with everybody, and who said what, and who attended, and this, that, and the other. And so, if it did ever come under scrutiny, that, in addition to the operating agreement that we had in our limited liability company, taken together, would be pretty strong evidence that we were, in fact, each and all of us actively engaged in that joint venture. And that's what you need. It's not enough your next question might be, which is commonly asked, well, why can't we just draft up an operating agreement that says we're all going to be doing whatever? And the problem is that just saying what you're going to do in an operating agreement is not enough, because if it were that easy to get around the securities laws, everybody would be doing it, and the SEC would crack down on that. So if it did ever come under scrutiny, you need to be able to prove that you were in fact actively engaged in a meaningful material way, not just you were the person who went to the store and got the coffee for everybody else who was making decisions.
So the advantages of an active a partner member of the joint venture as opposed to not engaging in this, are there advantages beyond the limited setup without having to deal with the SEC? Are there tax benefits? Is there anything beyond that?
Well, I'm not a CPA and we don't give tax advice, but in general, based upon my limited knowledge of tax, the tax benefits are going to be driven more by your structure of the deal and the entity and whatnot. And we've done both a straight-on LLC and an LLC in a joint venture, and ultimately, my experience is there's no material difference in the tax benefits involved. So that would not be a reason to do or not to do this particular joint venture over a syndication. So aside from tax benefits, the main advantages of a joint venture, there are many. I'm of the opinion, and I say this when I teach this topic, that it's the cheapest, easiest, fastest, and safest way to do a deal with other people's money. And again, anybody who is trying to take their investing to the next level is going to need to do deals with other people's money. They do that. And even there's a great article in the Wall Street Journal that discusses this very topic. And the article discusses that this is a strategy which increasingly we see family offices, which are basically the ultra high net worth, multi-generation family real estate, whether it's real estate or any other business venture. These are ultra high net worth companies, family offices that are coming together by using this very strategy, joint venture, not because they need the money. They got the money. They do it for other risk diversification and risk mitigation benefits. Specifically, it'll be for, let's say you've got a family office that has the expertise in and experience in multifamily, but then they want to do a shopping center. So they might want to partner up with a family office that has the experience that they don't. Or maybe it's a family office that historically has invested in one geographic area, say California, and they're going to go to another geographic area. So they might want to partner up with somebody else who has the experience in that geographic area, or just to diversify an existing portfolio, try to get a partner who can help spread the risk. So risk diversification, which again is investing 101, is the primary benefit of this strategy. The related benefit, which I think is huge, is perhaps best illustrated by me telling you another case study. So I have a client who was interested in buying a property here in the Bay Area. And this was back in late 2012. And he had a property under contract to buy, and he's buying it on a short sale, which a lot of people were doing back then. And he was on the fence. It was, these things take months, and he had this under contract for 6-7 months. And finally, the bank said, okay, we approve, you can do it. And at that point, we didn't know, at that point in the cycle, we didn't know when it was going to bottom out. And it was just in free fall. And so my client was concerned about, gee, should I go forward with this, or should I pass because it's already gone down as far as it has, but what happens if it keeps going down? And he was ready to pass on it. And I said, look, before you pass, I explained to him this strategy that I just explained to you. I said, why don't you try to find a partner, a joint venture partner, and run it by them? Because getting the input from another sophisticated investor who's ready to put their money where their mouth is a huge benefit. In this business, your risk tolerance is a key to what you ultimately do in this business. And getting your gut instinct to a point where you're in the sweet spot where you're not too conservative, but you're appropriately conservative when it comes to risk. You know what I'm talking about?
Yep.
This is something that almost every investor could use a input from another experienced investor who they respect. And so, because what you'll do is get somebody else's take on a deal that you might be on the fence on. That's what this guy did. My client, he spoke to the guy. The other guy said, you know what? I'm not concerned. I think we're close to the bottom. Let's do it. They did it. And as it turned out, the market actually hit bottom about a month after they bought the property. 6 months later, the property was worth twice as much as what they paid for it. But that happy ending is almost irrelevant to my point. My point is, it doesn't make a difference what ultimately happened. The main benefit was to be able to, again, diversify that risk and be able, going into it, if it did go the other way, at least that my client wasn't taking 100% of the risk. Plus, he was able to get a better gut instinct as to he was
verify his thinking there. Yeah, that's positive.
And plus the other thing that this does, you and I know this is a relationship business, and when you form these joint ventures with other sophisticated investors, experienced investors who have the ability to come in with that kind of money, you are creating the potential for future deal flow, which is the other thing that we need. We need deal flow. And so those are all such huge benefits to this that you just don't get in syndication. If you're going to syndicate a deal, you're not going to ask your investors what they think of the deal. You're going to tell them why it's a good deal. If you start asking your investors what they think, they're going to lose confidence in you. So that is, it's hard to overstate how important it is to have somebody that you can be at the same level with and get their input on the deal.
No, I like that. I want to ask you quick, you mentioned a couple times a sophisticated investor, which I'm familiar with in the syndication model. Is that a requirement for the joint venture?
As a practical matter, it is, because if you go into a deal with somebody who has less experience than you or materially less experience than you, then that would be if there is a problem down the road and that, let's say your partner for whatever reason becomes disgruntled and they go talk to a lawyer. Again, I'm a litigation attorney as well as a transactional attorney. The first thing I'm going to do if I represent that disgruntled investor is I'm going to say, let me see a copy of your documents and tell me about the setup and everything. And if it turns out that I see that there is an argument to be made that the partner was so much less experienced that he or she was relying upon you to make a profit in the deal, then that's going to open up a whole new category of potential remedies for that disgruntled investor under the securities laws that they wouldn't otherwise have. So as a practical matter, what you're looking for is somebody who is pretty much as close as possible to the same level of experience, if not more than what you have.
Got it. No, I think it certainly makes sense. I just didn't know if there was a requirement like with the syndication, the accredited investor or the sophisticated investor kind of thing there. So, got it. Clearly, you've kind of laid the case for the positive aspects of a joint venture. Are there any negative potential outcomes that to be aware of?
There are risks and there are negatives in virtually any strategy in real estate, and this is no exception. But honestly, most of the negatives are present in a syndication as well. I mean, if you have a difficult partner, you can have a difficult partner in a syndication. And I've seen situations where a difficult partner in syndication, a limited partner, an investor, in a syndication, can be just as difficult financially and in every other respect as having a difficult joint venture partner. I think the main difference in terms of what your potential problem could be, and I'll explain that in a second, is if you have a partner who has the ability, because of the way control is allocated in your deal, to basically get you into a deadlock situation that you're at loggerheads and you're stuck. And I say could be because, again, I have seen syndication operating agreements that give the limited partners effectively the ability to put you into that same deadlock position. And I have not drafted those. I've seen those in a litigation context. But the nightmare is, and I've seen this, where you have a requirement that a unanimous vote of the partners, the investors, is required to do certain major things like get a refinance or sell the property or whatever. And so if you are going to do a syndication, you really want to, and this discussion we're having now is not intended to be a discussion about syndication. Obviously, we could have another conversation about that. But if you are going to set up your syndication, hopefully you'll set it up in a way that eliminates that potential risk. But I've seen those, even today, I've seen those agreements that put you as the issuer, as the general, as the sponsor, whatever you want to call it, at risk for that same problem. But most of the properly formed syndications avoid that. So that would be the main negative that a joint venture could have over the a syndication. Again, one way to mitigate that, it depends how many partners you have, and you can isolate, and there are things that you can do in terms of setting up tie-breaking mechanisms and whatnot. But that's probably the single negative that you really have to be concerned about when you do joint ventures as opposed to syndications.
So pick your partners wisely, kind of thing. Yep.
Super important.
Yeah.
I mean, that's going to be true anyway. In a syndication, that's true too. But for sure, that is the single biggest thing that you have to be concerned about because it's a business marriage. And so you have to, and that's why whenever I am working with my clients to set up a joint venture, I always tell them I really need to see all the joint venture partners at once together in the same room so that I can help you best, because having done this for decades, I have, there are certain things that you pick up, body language, conversations, things that are said in that meeting where I have told prospective clients at that meeting that I think that you guys might want to rethink if this is going to be a good fit for you guys, because I noticed when we had the conversation about X, you guys had a difficult time working through it, and this is important and whatnot. So we have a whole special report that we have prepared for our clients called the 17 Steps to Setting Up a Successful Joint Venture, and a companion special report called 12 Warning Signs You're Headed for a Lawsuit with Your Partner. And it's really critical. My objective when I set up a joint venture or any entity is to keep my clients out of court. And the way to do that is to make sure you're drafting it correctly and helping the clients really understand the tough issues that need to be discussed up front, as opposed to after you sign and you're already married, you're already committed. So these are important. There are those there. You hit the nail on the head. Setting it up right from day one is your best protection from winding up in court. And as of today, I don't know of any joint venture or entity I've set up that where my clients ended up in court or even a dispute. So knock on wood, whatever we've been doing so far seems to have been working.
No, that's good to hear. I remember I had a client years ago kind of spelled it out for me that basically you go into business with all the instructions on how to unwind the business. Up front was kind of the his summary of it kind of thing, and I think that what I've seen more often than not is people get into business without the realization of it. There is an end point, whether it be sale or partners or death or whatever the case may be. And, if everything's planned for how you're going to exit the business at that point, whatever it may be, you've got a chance of leaving amicably and everybody, parting in some way or fashion and getting what they expected, as opposed to, disgruntled and angry and lawyered up and lawsuits and all that kind of fun stuff. So,
well, Darren, you're hitting on one of my favorite topics, one of the most frequently litigated and frequently overlooked provisions in any operating agreement or any kind of a joint, whether it's, again, a syndication or anything else, is a provision that does exactly what you're talking about, a buy-sell provision, which talks about what we call triggering incidents like a death, disability, withdrawal, expulsion, or bankruptcy, and anything else that might be appropriate. But that's, we make sure we include that provision in our agreements. So if you don't have that provision in your agreements, then if one of those things happen and you haven't agreed to it, then you will get it resolved, but it's not going to be you. It's going to be a stranger. They're called the judge, and it's going to cost you a lot of money to do it.
Yeah. Nope, sad but true. Jeff, I feel like we've walked through some amazing, clear, simple points, and you've brought a lot of information. Is there anything that we didn't talk about with respects to the joint venture that you would have liked to have imparted us with, or?
There's a lot there's so much on this
Sure.
topic, and it's near and dear to my heart. Primarily, the reason I started really focusing our education on this topic is because when I've seen the partner disputes go the distance and go, whether you're in court or in arbitration, it is to see the impact it has had on my clients. And when you represent somebody in litigation, I get to understand them on a level that is so rare. You get a real insight into what they're going through, and they're under fire. And I can tell you that no matter how much wealth my client may have, and no matter how sophisticated and smart they are, when you get into litigation, it's war, and it can have a really devastating emotional, psychological, and financial impact on your life. And after one of my more recent multi-million-dollar litigation matters, I said, you know what, I really got to start reaching out and educating investors like through you, so they understand this, because my objective is to make it so that you never do end up in that position, because it's such a tough way to go. So I think that if there's one takeaway, and you already hit on it, is if you're going to do whatever it is, whether it's a joint venture or a syndication, set it up right from the beginning. Make sure you're getting the right partner. Make sure that you have a lawyer who has the experience to set it up right. And that is ultimately going to be your best way of making sure that you have a great experience with joint ventures over and over again with different partners and whatnot. We've had many partners, and it's still my plan A. Even though I can set up my own syndication, it's my plan A for doing deals with other people.
No, that's great. No, it's sad but true. The exhaustion, I would say, is probably what I've seen. Just the taking the years off people's lives, of whether it be just litigation and the time and the money, and basically you're in a position of kind of a stall there for a while during that. So it takes its toll. Jeff, I've enjoyed this and would like to ask you if you'd be interested in coming back. It sounds like you've got a lot of topics we could go through at a future date with respects to real estate and law. If you'd be interested, the invitation is extended. So love to have you back.
Sure, we could absolutely do that.
All right. Before we wrap up here, where can the listeners go to find out more and connect with you?
So we have our website URL is easy for your listeners to remember, because it's who they are. It's Real Estate Investor Law. So it's just a law at the end of what they do. realestateinvestorlaw.com. And there are lots of free resources there. As I mentioned, there are a couple special reports right there on the homepage at the front and center at the top, where they can click on there and get a copy of those 2 free reports that I mentioned. There are also some articles and whatnot, and reach us there. And anybody, again, we represent clients in their transactions, no matter where they live in the United States, and for litigation in California. So we look forward to hearing from anybody who's listening to this and get to know you.
Great. Well, Jeff, thanks again, and look forward to doing it again soon.
Great. Thank you.
All right. For our listeners, if you like the show, share it with someone you know. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.